What is going on, investors? Hopefully you guys are having a great day out there. Time to talk about Home Depot Incorporated, ticker symbol HD. They just reported their Q1 earnings before the bell today. And I tell you what, we're going to jump into them. We're going to take a look at the revenue. We're going to take a look at the operating income. We'll take a look at the net income. We'll take a look at the balance sheet. We'll take a look at cash flows, all things that are going on financially over at Home Depot in the quarter. The other thing we're going to take a look at is this beautiful stock chart. Take a look. Back in March, this was under a $250 per share stock. And over a 2-month period, it bolted on nearly $100 to the share price, going up to $345. Now it's pulled back. We're sitting at about $317 on the shares of Home Depot now. So talk about, is this a buy the dip opportunity? Is this an area where you could potentially come in here and buy Home Depot if you want? The other thing we're going to do on today's show is we'll compare it to Lowe's. I think if you're a consumer out there, these two stores are somewhat interchangeable. They sell almost identical products, okay? And so we'll compare them from a traditional valuation metric. We'll look at price to earnings, and we'll also look at price to sales. So over the last year, Home Depot stock is up 33% year to date. We talked about how it's had a monster move. It's up 20% year to date. The other thing that we want to keep in mind is this stock pays a $6.60 per share dividend. That's good for 2% yield on this one. We'll talk about the not necessarily the safety, but the opportunity for growth in that dividend rate when we take a look at Home Depot's earnings. Now, from a traditional valuation perspective, we can compare this company to Lowe's, but here's what I don't want you to get out of this. I don't want you to look, yes, Home Depot and Lowe's are competitors in the market, but when we look at Home Depot's financials, and certainly we can look at Lowe's here in another day or two when they report, that while they're competing, they are dominant in their market, okay? And so this is not like rooting for the Yankees or the Red Sox, or being a Republican or a Democrat. Do not make that mistake in the stock market. Me personally, if I wanted to invest in the home improvement retail space, I tell you what, I'd want a piece of both of these companies, and I'd want to get them at good valuations. And so one way to do that is actually compare them to themselves, and then look to see if there's occasionally areas when one of them falls out of favor just slightly to the market. That could be a signal that that one, Lowe's or Home Depot, could be a buy versus the other one. From a price to earnings basis, they are trading virtually in lockstep. But if you've seen over the last year, sometimes Lowe's will trade at a discount from an earnings basis to Home Depot. In my opinion, that could be a buying opportunity for Lowe's. But at the current moment, they're trading about 25, 26 times. Now, what I thought was interesting was from a price to sales basis, Home Depot is appropriately in this orange and Lowe's is appropriately blue, but Home Depot gets a 2.6 times price to sales and Lowe's trades at about 1.6 times sales. So there's not a lot you can read out here. Now, one thing that I want to show you though is that Lowe's is growing almost identically at the same rate as Home Depot. And so one thing that sometimes investors do is they pay up for more accelerated earnings. But I noticed here's our Q1 in Home Depot, which we'll go over here in a second. They grew at 32%. Lowe's will get updated Q1 numbers here in the next day or two, but Lowe's grew their Q4 at 28%. So it's not that Home Depot is growing that much faster than Lowe's or vice versa. It's just occasionally the market will pay up for Home Depot earnings more than Lowe's. In my opinion, could be a buying opportunity if and when that materializes again. Now, jumping into the Q1 numbers here, we've got our statement of operations. That's the revenue and the profit over at Home Depot. On the right-hand column, we've got this last year, and the left-hand column is our most previous year, and then we've got a percent change year over year on a quarterly basis. We've got these net sales. Those grew nicely at 32%. I just did a video on Walmart. They grew at like 1%. And I know that Walmart has like over basically 3 times as many sales in a quarter than someone like Home Depot, but that's still just phenomenal growth. It just shows you that yes, Lowe's is quote unquote a competitor, but those two combined have very little competition, okay? There are some other brands out there like an Ace Hardware and some other ones out there, but these are the two dominant players in this space, and growing your top line at 32% is evidence of that, especially in the retail space. You got cost of sales coming in basically growing at the same rate. That is nice. That's not showing a lot of price inflation there, and so that's nice. That leads to gross profit up nicely. Okay, so you grew this top line 32.7%. To grow your gross profit almost identical there shows that, yes, maybe there's some price inflation, but you're able to pass that down to consumers. Not all stores can do that, or maybe we'll be able to do that in the future. That leads nice gross profit coming in at $12.7 billion versus $9.6 billion in the previous period. Now, they've got these other operating expenses, right? They've got selling, general, administrative. They got some depreciation and amortization. This is likely a non-cash charge, but it's such a small number. It's virtually a rounding error. That gets us down to these total operating expenses growing at 9.6%. And the one you'd probably focus on here is really this SG&A that grew at, I don't want to say only, but really only 9.3%. Someone like Home Depot that has lots and lots of employees, lots of stores, wage inflation wouldn't necessarily be a good thing, okay? Because that obviously would eat into profits, but right now we're not seeing evidence of that at all, okay? Because when you come down here to operating income, which takes your gross profit minus your operating expenses, you get this operating income in the quarter came in at $5.78 billion. What is that? 76.5% more than the previous year. That is absolutely phenomenal. To grow your net sales by 32%, grow your gross profit by 32%, but you grew your operating income by 76%. That is fantastic in my opinion. Now, you got some other things going on here. You got some interest expense and some other things going on. You got to pay some income taxes. That gets us down to net income, or in this case, net earnings, up 84%. You went from 2.2 billion up to 4.1 billion. And I told you a minute ago, they've got a $6.60 dividend. Well, in the quarter, just in 3 months, they earned $3.87 on this one. So you better believe not only is that dividend locked and stocked and secured, but boy, it could go up if they continue this type of performance. Now, moving on to balance sheet over at Home Depot. We've got our assets up here. We've got cash and cash equivalents. We've got our middle column is last year. Left-hand column is this year. January is the beginning of the year. All things being considered, it looks like they've burned through a little bit of cash. Maybe some of it's coming down here to inventory, because I see inventory ticked up to $19 billion. We were sitting at 15 last year, and at the beginning of the year, they were sitting about 16.7. So they bolted on quite a bit of inventory. So that's interesting as well, just kind of all on its own. Total current assets ticked up to $30 billion. Most of that, again, kind of flowing out of cash, it looks like a little bit, and a lot of that into inventory. So strong demand, strong positioning in your market like Home Depot has. Having inventory on hand, not necessarily a bad thing. And I tell you what, if you get inflation, having inventory sitting there kind of quote unquote appreciating, or at least going up in price, not necessarily a bad thing either. Total assets coming in big time, $72 billion. That's quite a bit over last year, but from the beginning of the year, basically up marginally. Now, they've got some long-term debt and things like that. It's sitting at about, we'll call that $35 billion. That's up a little bit from last year, but basically flat, down slightly from the beginning of the year. All things being considered, you've got to, I know some people look negatively on debt and things like that. At the rate this company is able to borrow, and the fact that they're growing their operating income, their net income so well, having this type of debt, not at all a concern in my opinion. Now, coming down to cash flows, you've got your 3 months ended right-hand columns last year. This is this year. Look at cash flows coming in solid, as you'd expect. So you pull down this net income number. This is phenomenal, $4.1 billion. You get to add back in depreciation, working capital, things of that nature. You ticked up from $5.7 billion all the way up to $6.3 billion. From an investing activities, not a lot going on here. I tell you what, you look at a Walmart, you look at an Amazon, obviously, man, they're really having to spend a lot of money on capital expenditures. Home Depot's kind of got it all built out already. Okay. They're in the markets they want to be in, and they are just really, really humming along. Really nice to see that. Now, from a financing activities, this is probably where some of the cash kind of burned. We talked about how some of the cash looked like it kind of got taken off the top of the company. Some of it might have flowed in inventory as well. But I think what we're seeing here is this repurchase of common stock. So you have this big $3.78 billion buyback. You've also got repayments on long-term debt. They did a big old payment of about $1.4 billion. And then you got these cash dividends as well. All of that is very, very shareholder friendly. You're paying down debt, you're buying back stock, and you're paying dividends. We see change in cash and cash equivalents down here. They basically burned through, or they spent $1.28 billion when you factor in cash flows from operations, cash flowing out from investing activities, and cash flowing out from the buyback, the dividend, and the repayment of long-term debt. All things being considered, it's a phenomenal quarter, and this company is firing on all cylinders. I love what I'm seeing from a financial perspective, a fundamental perspective. Now, from a technical perspective, let's take a look at the stock chart. Like we talked about, this stock was way down here at 250 and just rallied. Man, it got on a motorcycle, it popped a wheelie, and it went all the way up here to almost $350 per share. Unbelievable move. Okay, yeah, we kind of expected, or not really expected it, but it's understandable. We bottomed out here in March at 150, and then we made this big leg up. This leg right here, maybe it's like lumber future prices going up. I don't know, but this was just a monster move, okay? And we pulled forward a ton of stuff here with Home Depot. So here's what I see. Now, in the very shorter term, you could probably cut, I'm on a daily view on this chart. You could probably cut this down to a 5-minute view, 30-minute view, 60-minute view, and you probably could see a channel kind of forming right here between about where the stock is right now at about 316, 317 up to about 330. This could be an area. Look, if you like Home Depot, you want to get in this, you like the 2% yield, you like the fact that they're earning bunches and bunches of money from a net income perspective. They're not having to spend a lot of money on this business in terms of building out stores like maybe some more up and coming retailers have to do. They don't have to invest a lot. So a lot of these earnings are going to flow down to a buyback, or they're going to flow down to this dividend, and likely going to be able to increase that. This could be viewed as an area of support. You also have this moving average line that's coming up right here. It's sitting at 310. You're sitting at 317 on the stock price. That should act as a level of support on their stock. Now, more ideally, I like the stock down in here, 260 to 290. Anywhere in this box, you had a gigantic amount of sideways consolidation starting back in August of last year. Again, until about March of this year, you sideways consolidated in a very, very tight range. This level here at 260, I know that's like $50 from where the stock is, but that should serve as a very extremely hard level of support on this stock. Okay. If it breaks 260, I tell you what, you probably look out below, probably in the entire market, because if a stock like this breaks down, you're probably seeing that across the entire market. Your entire portfolio is getting kind of blown up. Now, a little bit more realistically, probably at least in the shorter term, you're sitting at $300 on this, or really at 290. I'm sorry, $290 per share is the first level of support on this one, and would be a first level if you really want to see kind of a pullback in valuation, that type of thing. Again, that's only about $20, $30 where the stock is right now, but that to me would be an ideal spot. Anywhere in this spot, 260 to 290 would be, in my opinion, especially from a dividend and a dividend growth perspective, really would like this stock from that perspective. So hopefully you guys enjoyed this video. We'll be back again with more all this week. Hopefully you guys had a great day. Good luck with your investments.